It should therefore be emphasized that, in order to preserve a healthy development of the business reality, it cannot be sufficient to achieve a sharing of intentions and strategic objectives, but it is necessary that the top management members also participate in the business risk through their own economic remuneration. In practice, all this translates into the use of management packages built in order to involve a fair balance between fixed and variable remuneration, by virtue of the characteristics of the business and the risks of the company and its sector. Predetermined, measurable performance objectives linked in a significant part to a long-term horizon, on which the payment of variable remuneration components is also based. The use of more complex equity instruments, such as long-term incentive plans, stock options or phantom stock option agreements, options, exit ratchets agreement and many others. Also in this case, an adequate time frame should be provided for the implementation and exercise of the agreements, again in order to be able to achieve a long-term goal. Clear and predetermined rules for the disbursement of any indemnity for termination of the relationship in the event that the interruption does not result from the failure to achieve the objectives. These rules define the maximum limit of the total amount payable by the company and any responsibilities of the management. The fil rouge of all these points is, in fact, the desire to align the interests of executive directors and top management with those of shareholders, envisaging long-term performance objectives, presumably more solid and sustainable over time. The more closely interests align between owners and managers leads to the implementation of restructuring activities aimed at improving a firm's efficiency through a better long-term control of costs. The disciplining role of debt prevents managers from wasting resources, for example by investing free cash flows in projects with negative net present values. It follows that agency theory contends that buyouts result in a superior governance model that, in turn, leads to improved firm performance. In order to increase the value of target companies, private equity exploits different strategies in order to get the highest value possible when exiting their investment. Strategies should be considered with the positioning of the fund declared in the fundraising phase. These strategies changed considerably in the last decades, and they are driven by the macroeconomic expansion or recession and by capital markets trends. It is possible to identify at least 4 strategies, where the adoption of one strategy does not exclude the adoption of other ones. If the private equity-backed company wants to consolidate the position in the market and establish a large industrial group, integrated either at a horizontal or vertical level, it may be necessary to acquire several companies.